With us, a former chairman, the Securities Exchange Commission, policy advisor to Goldman Sachs, member of the Bloomberg board, Arthur Levitt. Quote, "We should not set a speed limit to slow everyone down to the pace set by those unwilling or unable to compete at the highest levels of market activity." There's an uproar about trading, Arthur, and it's about the idea there's an unfair advantage here. Is there an unfair advantage by those with black boxes?
I don't think so, Tom. As chairman of the SEC, I instituted regulations specifically designed to foster today's competitive markets. Our markets today are the result of a decade of careful policies created to increase competition, to promote choice, and to broaden access to in order to benefit and protect investors. The whole name of the game for years, when we had active stock exchanges, was speed and price. How could we reduce the price in terms of commissions? How could we increase the speed? We're seeing that today. We've got the most liquid, vibrant markets ever in the history of America. And look what those markets did in the recent market meltdown as compared to what happened in the 80s.
Okay, History 101. You got your head handed to you a number of years ago on trading and accounting. Out of 87, we learned a lot of lessons over paper tickets. If we talk about price discovery, is there a risk here that this high-speed trading can get out in front of those of us that have to go at a more mortal speed?
No, I don't think so, Tom. I think quite the contrary. I think that in terms of price discovery, in terms of liquidity, the high-frequency trading is a net plus. Anybody can play. It isn't a market limited to a certain select number of people. It's access. It's using speed and volume. It's a net plus for investors who are getting better executions, better prices at a lower cost.
Well, Arthur, if there's no front running, is that just because of the nature of the computerized system, or does it have to do with something that came down from Washington?
Well, front running is something that's totally different. It's where a select group of investors have information that isn't available to others, and they're taking advantage of that information and trading ahead of others. This is not at all the case here. This is a regular market process. This is a result, again, of rules that were passed in the 90s that permitted electronic markets to take place. This is the natural evolution of an electronic market, and it is a very constructive, positive development.
I want to interrupt here, Ken. John Deere out with a headline that I think shows a struggle within that industry. Deere's year forecast implies a near break-even fourth quarter. The plug-in is an estimated 35 cents as our team dives through the Deere press release on earnings. Arthur, when you look at all of the high-speed trading, let's be blunt, there's a distrust here of the smart guys on Wall Street. You are a policy advisor to Goldman Sachs. With all your relationships, not just Goldman Sachs, how do the trading guys and the executives around the trading guys respond to this criticism? How do they respond in your discussions on the street about, hey, we're just trying to do something with technology?
You know, I think there's been huge criticism in a populist America of financial services in general. And obvious, this drumbeat of criticism has an impact upon all firms, all practitioners in the industry. With respect to high-frequency trading, obviously they're concerned about that because it's something new. It's something that isn't understood in the same way that options were new, that futures were new, and that misused in some way, the public could have been hurt. High-frequency trading, however, and this is the irony of it all, is a net positive for the public. Again, it's squeezing down spreads. It's squeezing down costs. It's getting better execution and adding liquidity. But you ask a good question, and I would say that the industry is reeling from the drumbeat of criticism that comes from principally regulatory sources, congressional, legislative sources, and from a populist public that is fed up with issues such as excessive, so-called excessive compensation. And this gets muddled in that philosophic debate which is ringing around America today.
Well, Arthur, this wave of populism we talk about includes outrage from various quarters about that guy who runs Fibro, the commodities trading arm of Citigroup, who's in line for $100 million, and there are various calls not to pay him that, although apparently his contract says that's the number.
Well, we have to honor contracts, and I understand that populist fury, but the real answer here is balance. I don't know the details of the payment to this guy.
I'd like to see his art collection.
Yeah. But obviously it angers people who are out of work, out of jobs.
But Brett Favre is going to play for the Minnesota Vikings, and he's going to make, what, $100 million?
Well, there's that kid at San Diego State who's going to get $15 million to pitch for the Washington Nationals. He hasn't thrown a single pitch in Major League Baseball.
What's the difference?
So
Arthur Levitt, what is the difference between a guy under contract making $100 large versus, what is it, Rich Truman, $25 million for 2 years?
The difference is the industry that they are part of. The sports industry is one that people are used to and comfortable with. Financial services are not understood. People have been hurt by financial services in ways they haven't been hurt by sport. Where does their anger go? In the direction of where their pain has come from. It hasn't come from sports. It's come from financial services.
Well, of course, there was that time when a reporter pointed out to Babe Ruth that he was paid more than the President of the United States, and the Babe said Hoover had a bad year.
Yeah. Well, we'll come back here, folks. Bloomberg Surveillance. David Malpass will be with us in the next half hour. Arthur Levitt will stay around for our next block, which is great. Thrilled to continue. I want to talk to Arthur Levitt about two laureates talking yesterday. They were all Levitt. They were all fair market accounting. We'll talk about Robert Merton and Robert Kaplan with Chairman Levitt when we come back. Dollar yen 94.26. Euro dollar $1.41.29. Sterling, the big story there. You heard that from Sarah Eisen a number of minutes ago. $1.6426. She boosted sterling there alone with her work. 2-year yield 0.9756. That's the statistic that gets my attention this morning.
Let's take a look at news you need from around the world this morning. A series of bombings in Baghdad killed 75 and injured more than 300. South Korea aborted its first space launch less than 8 minutes before the scheduled takeoff, citing glitches with ground equipment. Hurricane Bill, now a Category 4 storm. Meteorologists say it's moving between Bermuda and the east coast of the U.S. Bloomberg's John Bascom will have more coming up in a few minutes. In sports, Yankees win, Mets win, and Brett Favre is back in the NFL. This time he's wearing purple.
He's wearing purple. Don't forget our podcast. They're at Bloomberg.com and on iTunes under Business and Business News. Look there for the podcast I had last night with Myron Scholes, the laureate of 1997. More with Arthur Levitt. It's Bloomberg Surveillance. As we do with Arthur Levitt, Bloomberg board member, policy advisor to Goldman Sachs, and a very happy guy after seeing Merton, the 97 laureate, and Robert Kaplan, among others, in the FT yesterday. Kaplan, Merton, and Scott Richard of Wharton, they didn't mince words, disclosed the fair value of complex securities. Are we any nearer there after 2 years of crisis?
I'm not sure. The FASB certainly has begun to modify their caving into absolutely outrageous congressional badgering 3 months ago. But the banks are clearly holding back on what their true position is. And when Merton and his colleagues argue very correctly that our market today is sufficiently open enough and transparent enough that those securities can be valued, that no longer can the banks hide behind the shield, that these are so opaque that they cannot possibly reveal what the true value of those securities are, that obviously they're not holding until the end of their contracts.
With all of this and all of your research on this and the advisors you have, do we need a jump condition to full fair value market accounting, or can we tranche our way in over time? Can we say, hey, we're doing this over 4 years, guys, here's the plan?
I mean, the question, Tom, is do you want an accurate picture of how Citibank stands and Bank of America stands, or do you want a partially accurate picture? Now, that's the answer to your question. I think it's either accurate or it isn't. And why let analysts and investors wonder what lies behind that golden curtain?
You mentioned when we were on break about short selling. Give us an update on short selling. As usual, we've gone up. The problem's gone away, hasn't it?
Yeah, it has to some extent, but there's still a populist anger out there which blames the unknown for all the problems. The SEC made a terrible mistake, in my judgment, when they banned short selling during the midst of the crisis. Short selling is part of the process of price discovery. Now, again, in response to public pressure, the SEC is considering a partial ban of short selling, one that would be triggered by some kind of circuit breakers. I think that's better than what we had before, but still I believe short selling is part of the market process, part of the vital process of price discovery, and we shouldn't have these road bumps put in the way of selling short.
Interesting. Let's leave it there.